Hello ladies and gentlemen, and welcome back to a special weekend edition of Markets Around the World. Well, for many of us, we did not want to see a candle like this form at the end of the week. As we say, the close is the key, and previous times we've seen a candle like this, there's been more bad things to come. Unfortunately, we're also at a point where we could be going to a watershed moment, a maximum fear or capitulation level. But the story doesn't really get any better when we start to look underneath the hood. Ahead this week, we have the inflation numbers, the FOMC meeting minutes, and we just saw a pretty strong number come out of the US jobs. This is a problem because, of course, the US is trying to slow down the economy, trying to ruin demand. That's not what's happening right now, and that's spiking interest rates. Many things like the island reversal that we've used so effectively so far over the last 3 months to really call tops and bottoms in the markets are now being reversed instantaneously. We've gone from a bullish kind of signal to a potential bearish signal in only a few days. And on top of this, there's thrust, breadth, and a whole bunch of other things that we need to look at right now in this market. So we enter into what is a pivotal time. Could it be the watershed, or is it going to be that sneaky turnaround that many people want out there? Join us as we go through everything to do with the markets for the week ahead, guys. See you soon. Well, welcome back everybody to the Daily Show where we talk about stocks, commodities, and cryptos. Let's begin by discussing some big news stories, the macro data, the lead indicators, and then we'll get into the charts and the key levels we should be watching. Non-farm employment's the biggest jobs number of the month in the world coming out from the US on Friday. And it was the same story we usually see, except that it was stronger than anybody had hoped for. The Federal Reserve is trying to push rates and weaken demand in the US economy. The jobs numbers are showing us it isn't working just yet. They actually dropped 0.2%. We are now at a very low 3.5% unemployment rate. And you'd think that's great, but unfortunately it isn't in 2022. Underneath the hood though, the US economy still looks pretty bad because full-time employment is still the main problem here. And with the jobs numbers, it's just so much part-time employment. Remember, I think you only have to be employed for 1 hour in the month to count as being employed. It's still an underemployment realistic economy out there throughout most of the world. When we're talking about target rate probabilities, the economists all believe that it's going to be between 50 and 75 basis points moving forward. And this is going to be the story. Realistically, in this current market, if you're an investor or even swing trader, watching yields is the story. Remember this stat, everybody. 2-year yields peak around 1 to 1.5 months before the end of the Fed hiking cycle. That should be around that time that realistically markets will bottom off. Once the 2-year yield has peaked, you'll see usually the bottoming of the market because that's what everybody cares about. What's happening with interest rates? When will the Fed stop? When will they beat inflation? This has been the stat that's covered through most of the other big peak times. Speaking of inflation, here's the problem we've got. We've got basically a very high number coming back through. Only a few weeks ago, we saw a dropping of interest rates. The market liked that and the market started turning around. Now, what have we got? A huge spike back up again. Should we make a new high? Guess what that means for stock markets? Most likely making newer lows. And of course, fear will be in the street should this continue to rise. Do also remember that when markets have tended to capitulate, we usually see major stock ETFs having massive outflows. We're not seeing that. We're not seeing that massive fear selling. We're seeing a lot of hedging, but we're not necessarily seeing the fear selling that's been synonymous with previous capitulation lows. This is going to be something that a lot of bigger investors are going to want to watch in markets. Do we see maximum fear? At this point, it doesn't really look like it. What about under the hood though? What about the average American consumer or any consumer around the world? Well, this is the story. Savings have gone all the way back down from all of those beautiful spikes that we saw thanks to the printing press and of course the checks coming out. We've now gone all the way back down to basically a very similar level where we were around that GFC. The unfortunate truth is though, people still spending, so they're not hurting the demand story. Look at the credit. The credit increase has gone above previous highs. And this is going to be a story that I think is a big issue. Everybody thinks they're still rich, that we all think we've got lots of money, but unfortunately the truth is that the savings is way worse than it was for a very, very long time. So what does this bring us to? Well, it brings us to a really tough time in markets because we've got a bullish case and a bearish case to discuss today. Hopefully, you can bear with me while we go through both of these because they're both going to be really important. On the beginning of September into October, only year that was really, really bad in October was 2008. Now, you can definitely make a case that we are very close in synergy with 2008. Most of the time, though, midterm election years, all of these other things, we tend to see turns in October. And that, of course, strengthens the case for a potential bull run, even though things look fairly dire right now. Let's also discuss the idea of when you know markets usually have bottomed off. And generally speaking, it's been the Nasdaq that has led the bottom to the peaking. Nasdaq 100 bottoms 4 to 6 months on average ahead of the S&P 500. Here's some big stats from 1999, the crash that happened then, and of course the 2008 GFC, something you might want to pause on if you're interested. So the bull case, let's talk about that first. Well, of course, we saw 100% bid last week on Tuesday. This is a really rare stat, guys. This is something that's only happened 6 times since 1996. And what has happened is actually the market often, if you actually look here, has gone down straight after that, but then returned with some strong movement straight after that point. It usually, or in fact, it never has been synonymous with bear market rallies. That is, the rally that was put in after these points has tended to be real and tended to be very, very strong. So if you took that stat by itself, you'd feel pretty positive. Now, we discussed the idea that everyone's selling off assets, but still there's a huge amount of inflows into the ETFs around the world. Yes, people have been selling off, especially bonds and other asset classes, but in the stock market, we're not seeing that pure fear that we generally see with bottoms. As you can see here, though, in terms of every asset, we are at record lows. There's still a lot of fear in that market across all asset classes. And when we've started to see some of these readings, we talked about the idea that when we had thrust, we had breadth, what happened later, what happened after these points. Well, when we saw a 5-to-1 up-down issue on the New York Stock Exchange, the week of that week, in terms of the reading, was tended to be quite poor. Guess what? We just went through that week. Last week was when we started to get this reading, so therefore we're now in week 2 on these data. And this is where things tend to improve. So I still think you've got to be open to the bull case here, should you see the right technical signals. If you think about after back-to-back days of issues and volume thrusts, again, the first week, which was last week, was the terrible one. And 2 weeks later, you actually had some incredible positive stats coming in from the market. It could be a massive fake out here, what's going on with that jobs number on Friday and with yields. Smart money versus dumb money, another bullish indicator. We're seeing smart money and dumb money literally widen in their gap. We've seen this previous times. And of course, we know what happened after this occurred. We actually got those rallies coming through on the markets, and that tended to lead into a little bit of strength, although it was still met by sell demand after that. When we've had the spreads, again, 1 week, that was last week, 2 weeks later, 1 month later, tend to be positive. You've got to keep your mind open to this. The stats all showed that last week should have been negative, which it was, then that this week could potentially be a little bit more positive. That's going to be something that's going to play out here potentially in the markets. If we're thinking about midterm election years, October, yes, October, November, December tend to be the best months of that year. Midterms have been horrible for the start, better at the end. If we think about every other September, October since 1931, we tend to see more selling in October into a back-end November kind of rally. So again, you could make either case here for that. If we think about bear market rallies in general, here are all the stats. Pause the video if you want to have a look at 200 years of data. And as we know, we are most closely correlated at the moment with 2008. And we're about here at this stage pulling back. So this is where we saw the watershed moment happening from 2008. The true, just absolute panic fear. Are we about to enter that? You've got to be very careful here over the next couple of weeks because that's the synergy that many people are making in these markets. So just before we get into the charts and the key levels that you need to be watching right now, I'd like to give a big shout out of today's sponsor of the video, which is Tiger Brokers. Now, many of you would be aware by now that markets have been brutal in 2022, and a lot of you like Tesla. Now, of course, we talked about this idea of the double top, the movement from A equaling B and the market potentially going down to this level here. If you weren't aware, Friday was a pretty bad day. So the markets are pushed back down into that level of demand. This is why it's important to have a platform where you can set alerts. And of course, Tiger Brokers, you can do so. You can basically set all these alerts. You can set whatever zones you want. And then of course, you can put them on your charts. And this is what becomes very important when you're talking about having a broker that gives you accessibility to a whole bunch of features. So you'll notice there I just set an alert for 220 just in case it happens. And of course, you could set it for any zone that you wish to. The other thing that's great about Tiger Brokers is they have a whole bunch of extra data on the right-hand side. Level 1, level 2 data. And then on top of that, you also get access to their financials, analysis, and all these other features. You can click on the little More tab and it will load up so much information about the company. Do you know how many different platforms sometimes you have to use just to get these things? You can see the business, you can see the earnings over time, you can see the filings if you wish to, the short interest, nasty Wall Street having to go at trying to kill Elon's stock. And then of course you've got things like dividends, if they're there, financials, valuations, and everything else. So if you're interested at the moment, of course, there is a special promotion for Australian viewers out there and some other viewers if you look in the description down below. But Australian viewers will get 20 free zip stock if you open up an account and fund it with as little as 1 cent. And for everybody else, there's a whole bunch of special offers down below. So if you're interested in finding out more, click the links. And of course, if you want some of these cool features, you can get it just by opening an account. Thanks so much, guys. Well, welcome back, and let's get into all of the charts. We'll begin here for the S&P 500 stocks above the 200-day moving average. And you'll notice that we're back on the blue line again. Basically, this is where we started to see in previous markets a turnaround story. Now, the outlier to that was, of course, 2008. The market fell in a massive watershed moment right here. See the similarities? Very similar in terms of the way it was. Then we sat at a very low level in terms of percentages above the 200-day moving average as we finalized the lows for the market. This is why so many people are pointing towards this could be that waterfall, that watershed moment for markets around the world. It could push Bitcoin down into the 10s or even 11,000s or even 9.5, which we've long thought could be the lows for it. It could push stocks back to their pre-pandemic highs. These are the types of lows that people have been discussing, and it could just be around the corner should we see another bad inflation print. The VIX spiked a little bit. Again, we haven't seen it go above 45, which is usually synonymous with the market lows. 45 plus has been what you've seen realistically over the last couple of decades being those low capitulation lows. And we're still open to that idea as both traders and investors. If we move over to yields, here's really the story. Look at the 2-year, almost back to the highs here, almost making new highs as of the jobs number on Friday. And yet the stock market hates those. I mean, unless we're seeing a topping of yields here, we can't really go up. Higher yields, bad for the market, especially bad for growth. And it means the Fed has more work to do. And of course, the market is going to tell us here. Watch the yields, guys. It's going to be super important. I'll just quickly bring up some yields in the future so you can see what's happening here. By December of 2022, we're expected, I'll just remove this so you guys can see it. We're expected to be at 4.1%. By April of 2023, 4.6%. And then now the rate cuts don't seem to be there in the same level as they were. By September of 2023, we're still at 4.58 and a very similar read by December. So what happened over the last 2 weeks was basically this. We were going super high in rates to 4.75, which is becoming more the problem here. And then we were going to sit at rates till December of 2023. Then it dropped considerably, maybe even 2 rate cuts. This is literally what's happened over 2 weeks. And now we're sitting at basically a potential 1 cut by the end of 2023. So a big change here in yields across the world. And that's what's making the markets move. What about the bonds? Well, the bonds hated it. They hated the jobs number and they sold off. Both high yield bonds, so more risky bonds, and corporate grade debt was both down. And we talked about this. We talked about some lead indicators. Things were improving. That big bit of news came out. It didn't show the slowdown that I think many people believed could have been the US market. And instantly we saw a sell-off across all bonds as yields spiked across the board. Even copper hated it. Look at this sell-off here on copper. It was a horrible week for copper. It sold off and it formed another really bad looking candle. And unfortunately, this is kind of leading into that story we discussed. The idea that weakness could be just around the corner and potentially that watershed moment. I don't want to freak anyone else out, but it is possible because we're seeing these types of weakness levels. The best thing that we've got in the bullish case here is the thrust, the breadth, and all those leads that tended to be very good points for markets to lower off. And I'm still thinking that there's a case here when we get into the S&P 500 later for a potential bull turn right around where we are opening up pretty much on the Tuesday, because remember, we will have the public holiday on the Monday. When we look at TLT, 20-year Treasury yields, yeah, it's again a story here of demand issues. As we know, if yields are going up, what's going to happen with the Treasury yields? They're going to go down. We're still at that very critical level. We haven't seen the turn story here yet, but we will be looking underneath the hood at TLT soon, because this is the right level for it to potentially turn. And if yields really get out of control, guess where Treasuries are going? It could be really bad, back down to 88. Be careful here, guys. Treasuries are probably a really good turn point eventually, but we're in the right zone. I can definitely make a case for it, but we haven't seen the big turnaround to show us the bulls are back in control. Let's speak about the world's greatest hedge right now, the US dollar, and big strong move here. We talked about the 110.25 last week. It was certainly bullish. It moved into the supplies, which was pretty cool. We had the first supply sold off, moved up, and then we broke out from this high. If you're thinking of going long in stock markets, what you're going to need to see is the dollar come back down. And specifically, it's going to need to break underneath that kind of 112 level. And that would kind of solidify a nice turnaround story on the smaller time frames. Basically a peak, a higher peak, and then a lower trough. Once that occurs, okay, cool. There could be bearishness. But at the time of recording, it looks like US dollar is going to remain relatively strong and move into that 113.50 supply. So if that happens, what are we going to see on the stock market? Potentially a new low. You've got to be careful here, because that could mean the US dollar is going towards the promised land, the 120, the level that it hasn't been at for years. But if you look over here, you'll see I've got that big line here. That's that previous high that happened back in 2001 and 2002 during the crisis of that period. So watch it here. The weekly close looks kind of bullish. And of course, the bear case is only going to happen if it goes underneath that very important zone. So what does this mean for gold? Well, gold hit our supply level and it sold off that level and it sold off that range. When we scroll down to the 1 hour time frame, you can see here that it broke underneath that last level of demand. And you would think at this stage that potential rallies could be met by sell demand as well. Levels like this zone here around that 1,711 kind of level could be pushed down, and we might move all the way back down to 1662, which was the previous demand. Be careful here on gold. It's going to be a very tough time. October tends to be one of the worst months for gold across the board. So just remember that gold can suffer from seasonality around this period of year. With OPEC cutting barrels, we've just seen even stronger gains here in oil. Again, it's not really the strong kind of thing that you want to see from the markets. I still remain bearish on oil over the medium to long term, but yeah, this is the spike that's caused by the cartel getting involved in it. And once they do it, they spike the barrel. And of course, we're moving back now potentially into that 95 to 96 type of zone. Be careful here on oil. It's very, very manipulated at this stage, and it could switch like this with only a few words being said. Let's move over to Tesla. So this actually hit the level that we'd hoped it would. We got that kind of A equals B, the double top pattern. For people that are trading Tesla, now we're in a very important zone. We're basically in that demand area. Do we see a turnaround here? Well, of course, that will really matter more on stock markets, but I could see buyers coming back in for Tesla around this level, and a new low, that would be one like we had in the Tiger Broker section just before. That would be a very, very critical level to set alerts for sure. Let's move over here to Apple. What's going on with Apple? Well, it's looking kind of bad. I mean, we get, of course, that island reversal at this stage towards the downside. If Apple fails, where's it going? Is it going just down into this level? You'd expect buyers to come back in around 134.50. That zone should be fairly strong for Apple, but nothing much holding it up at this stage in these markets. What about the DAX? Well, it fell off. You can see it hit the 20 moving average here, but realistically it hit that previous support, becomes resistance level, and it just sold off with the US. Not looking very strong here. It's going to need the US to turn it. If you go down to the small time frames, the only way we can really look at this from a technical standpoint is basically saying, well, we're back into this market structure. There's a potential that it could hover in here and find some form of demand. Again, I wouldn't be looking at the DAX as the lead here. Instead, I'd be looking at the US market. Semiconductors in the US market, a big sell-off again, an island reversal potentially towards the downside. Big volume in that sell as well, which is a bit of a problem here for markets. When we move over to the Ftse looks a little bit better thanks to oil, and it could be still an inverse head and shoulder, left shoulder, head, right shoulder. If you zoom out, this is an incredibly important demand zone to hold. And if we break above that 7100, you may see some strength across all markets, and especially the Ftse, because it would be sitting up as a pretty nice inverse head and shoulders at that point. The US 2000, the small caps, they got smashed as well. We talked about this level being pretty strong. We're back into the market structure at this point for markets like the Russell. And I think we need to go back over to something like the Nasdaq to really gain a bit more of a story. So you'll notice the Nasdaq absolutely, completely blasted this zone. That was the previous gap. So we had a gap at 11,228. That was a gap open. And then we also had one that sat around 10,967. You'll notice we basically hit that on the Friday session. So we've now filled the two gaps that were down below, but we haven't filled the new one that's opened up in between here after the jobs number. The Nasdaq is really, really interesting because if it's going to fall to a new low, where does it go underneath here? That's the issue. You know, a lot of people are looking at the Nasdaq and they're saying, well, around this area, we should have seen buyers. We did initially, but if it falls through here, that opens up potentially the pre-pandemic or at least that 10,400 zone. And a lot of people are starting to use Elliott wave theory and a few others to say that we're going into the wave 5 move. So that would be basically you've got kind of like your 1, your 2, your 3, your 4, and then this is your 5th move. And the 5th move can get a little bit, dangerous as well, as you can imagine. S&P 500 is the same thing. You've got that 1, the 2, the 3, the 4, and the potential 5th move. I don't use Elliott wave that often, but of course, this is the general concept here. For that to become invalidated, what do we need? A new high. So for the S&P 500, we need above 3,800 plus. That will then push to us going to these levels. And I think if that happens now, you've got to believe that the market is going to want to put in a 4,100 if we do get a new high, 3,800 plus over the next couple of weeks. Volume has been high. There's been a consistent kind of story of buyers and sellers, as we saw with the thrust. What I do notice, though, with markets at the moment is that they're absolutely smashing utilities. And this is interesting because if you go back through history, what you'll notice is that utilities tends to be defensive and it gets smashed kind of near the end. So even in the period here of 2008, which we've been talking about a lot, once utilities started getting smashed, the rest of the market had that watershed moment, and then all of a sudden we backed up. So yeah, even the defensive sectors are now getting absolutely destroyed in these markets, and that is something that's very interesting. Utilities have been a stronghold for 2022. Check this out. We've got 19% down for utilities. I'll bring a video later on this week talking about this, but this is what I'm looking under the hood. Very strange times to see utilities go down so hard in what has been one of the most defensive sectors in the markets. Let's go over now to the futures of the S&P 500 though, and I want to bring up how important this zone is that we're basically sitting on. We'll go down to a 2-hour chart, and what we'll do is we'll put a volume profile on it across the board. So we'll basically put a fixed range volume profile on the move here. Now, what you'll notice is that we are just closing on that value area low. So we smashed through the POC. On the previous video, we talked about the idea that as soon as 3720 was taken, that unfortunately the bears would be out in control. And I want to just zoom in here so you can see this. It literally was what happened, and it actually happened before the market even came out with the result. We saw it take it a few hours before the non-farm payrolls. It took the low of 37.20 and went underneath. It rallied up to gain that liquidity and it just smashed down. And you'll notice that initial reaction to the non-farms was slightly positive, and then it just went bang straight back down. And yeah, I mean, it was pretty much a bloodbath. But this is a big turning point. If the market's going to find buyers, you'd have to hope it's here. Previous supports, previous demand. Could it be demand again? The buyers came barely in at the end. They kind of went, yeah, I'm kind of interested in taking this over the long weekend. I'm kind of interested. If buyers are going to show commitment, they have to not allow new lows to form. If new lows form, could we be looking at capitulation? Yeah, I mean, we're probably going to like a 3,500 at that point, and potentially even a 3,400, or it may be even lower. Anything's possible after we make a new low, especially the way we've done it. So it's time now for the bulls to show their commitment. What the hell was that thrust? What was that breadth? What was that 6 times in literally over 20 years, 100% bid? If the market's going to turn it, you'd think they'd want to do it pretty much around this zone. When we look at something like the Bitcoin market over the weekend, it's holding pretty well. It's holding up as best it can. You can see it hit that supply level. We never quite took out our alert, which was set here to show us the buyers were back in control, and people have been shorting in this supply zone. Congrats to you guys. If this market goes into a watershed moment, what's going to happen with Bitcoin? Well, I've said it a few times. I believe Bitcoin will go to 11.5 and 9.5, somewhere in that range. And that's due to previous cycles falling between 83 and 86%. And if you actually measure it, that's the range. So there's a lot of transactions going on here in Bitcoin. If markets cannot hold, especially the stock market, watch out down below, guys. Set your alerts. Make sure you have a platform like Tiger Brokers to set those alerts so that you can be aware when big things do occur. Sometimes you miss it, and that can miss opportunity. If you haven't already, follow us on Twitter at FX Evolution, and of course, be ready for the news ahead. FOMC meeting minutes and PPI coming out Wednesday, October the 12th. Do remember, we've got a public holiday here on Monday, so there's no market. I'll be doing the live stream on Tuesday for the open, guys. And then we move through to the biggest one, I think, this week, which has got to be the Thursday number. The evil inflation number, guys. Thursday, October the 13th, 8.1%. So it's expected to drop. Will we see a proper drop in inflation? A lot of bulls are going to want this. Like, if it doesn't happen, watch out, guys. Inflation is going to be super key. If that comes in with like a 9% reading, freak out, go hide under the table unless you're short, because that'll be pretty bad. Then we've got core retail sales on Friday. Prelim UOM consumer sentiment. So it's still a jam-packed news week. And as the Fed is data dependent, remember, this is what's going to move the markets. If you haven't already subscribed, consider doing so. And of course, check out the sponsor of today's video, Tiger Brokers, if you're interested in getting some of the special offers and, more importantly, getting access to a great platform. Thanks so much, guys. We'll see you in the next video. Bye for now.